Welcome to the debate. Today, we are opening up the engine of the current market cycle to look at a mechanism that is driving, well, trillions of dollars in volume, yet it remains arguably the most controversial concept among the purists. We are talking about paper Bitcoin.
Right, the financialization of the asset.
Exactly. Futures, ETFs, exchange balances, wrapped tokens. Basically, these are the instruments that give you exposure to the price, but they don't actually give you the keys.
And that distinction, exposure versus ownership, is, well, it's not just semantics. It is the fundamental difference between financial sovereignty and just buying an IOU from a system that has, frankly, failed repeatedly. The central question for our debate today is simple. Is this financial layer the necessary evolution of Bitcoin into a global standard, or is it a Trojan horse that reintroduces the very systemic risks the asset was built to destroy?
Yeah, and I think we have to start by framing the sheer scale of this. We aren't just talking about a few retail day traders anymore. We are analyzing a market structure where entities like US spot ETFs, corporate treasuries, and major centralized exchanges now control a staggering percentage of the total supply. My stance on this is clear. I believe this paper Bitcoin ecosystem is the primary engine for liquidity, for price discovery, and ultimately global adoption. It legitimizes the asset for the world stage.
And I take the opposing view. I see it as the re-centralization of a decentralized asset. I'll be arguing that paper Bitcoin introduces opacity, dangerous leverage, and the potential for catastrophic failure through rehypothecation, which is essentially banks selling the same Bitcoin to 5 different people. If you cannot verify the on-chain assets, you're trusting a third party, and in this industry, trust is usually the precursor to bankruptcy.
Well, let's get into the definitions first, because I feel like paper Bitcoin is often used as a bit of a slur. When I say paper Bitcoin, I am not talking about scams. I'm talking about accessibility. I'm talking about the CME futures market, the ETF shares sitting in a standard 401k, and the balances on major regulated exchanges.
But you are conflating accessibility with safety. I mean, they are not the same thing.
I'm talking about market mechanics. Look at the history here. Every major structural bull run has been catalyzed by a paper event. Go back to December 2017. The launch of CME futures was the first time institutional investors could legally touch the asset. It validated the market. Then look at 2020. You had Strategy, formerly MicroStrategy, utilizing capital markets to acquire the asset. That kicked off the 2021 run. And most recently, the 2024 bull market and that historic high of $126,000, that was driven almost entirely by the inflows into spot ETFs. Without these instruments, the asset remains illiquid and niche.
I don't dispute that financialization pumps the price. My argument is that it hollows out the value proposition. You mentioned 2017 and 2020, but let's look at the graveyards in between those cycles. The history of this industry is completely littered with entities that offered paper balances right up until the exact moment the doors locked.
You're going to bring up Mt. Gox.
I have to. I mean, in 2014, Mt. Gox handled nearly 80% of all global trades. Everyone felt safe because everyone was there. But they were trading numbers on a database, not assets on a chain. When it collapsed, 850,000 units vanished. Those users held paper claims, they held IOUs, and they lost everything.
That was over a decade ago. The infrastructure back then was held together with duct tape and PHP scripts. It's not a fair comparison to today's market.
Okay, then let's talk about 2022, FTX. Billions of dollars in customer funds. Users logged in, they saw a balance on their screen that said 1 Bitcoin. But in the background, FTX had taken that money and gambled it on political donations and venture deals. There was no Bitcoin. That is paper Bitcoin in its purest, most toxic form.
Look, FTX was flat out fraud. You cannot equate criminal fraud with a regulated market structure. That's a category error.
Is it? Or is fraud just what we call it when the leverage finally breaks? The mechanism that enabled FTX is the exact same mechanism used by regulated banks. It's the separation of the user from the asset. If you do not hold the keys, you are relying on an internal ledger.
But we have solved for that with the current crop of institutional players. And this really brings us to the core of the legitimacy argument. You are comparing a fraudster and a penthouse in the Bahamas to BlackRock and Fidelity.
These are U.S. regulated entities subject to strict audits.
Audits. Let's drill down on that word. Audits are paper. An audit is a snapshot in time where an accounting firm says, yes, on this specific day, the funds were there. The blockchain, on the other hand, is a real-time, immutable truth. And yet, if we look at the data today, ETFs hold roughly 7% of the total supply. That's about 1.6 million units. Treasury companies hold another 5%. That is a massive concentration of wealth sitting in black boxes.
They aren't black boxes, though. They are public companies with strict reporting requirements.
Then why won't they prove it on-chain? Take Strategy as an example. They claim to hold over 700,000 units. That is a mind-boggling amount of supply. On-chain sleuths like Arkham Intelligence have spent months trying to map those specific wallets, and they've found a lot, sure, but they leave at least 110,000 units unaccounted for.
Unaccounted for by a third-party website does not mean missing.
It means opaque. And where there is opacity, there is the risk of rehypothecation. For anyone listening who might not know the term, rehypothecation is when a custodian takes the asset you deposited and lends it out to someone else to earn yield. Then that person lends it out again. Suddenly, you have 3 different people claiming ownership of the exact same asset. It's a game of musical chairs. When the music stops, when everyone tries to withdraw at once, you realize there aren't enough chairs.
I think you are projecting the sins of the crypto-native Wild West onto traditional finance. Strategy and the ETF issuers have very valid operational reasons for not broadcasting their wallet addresses to the public.
Such as?
Security, for one. We are talking about tens of billions of dollars. You do not want to paint a target on your back for every state-sponsored hacker group in the world. Secondly, market impact. If the entire market is watching a wallet with 700,000 units and they move 50 of them just for a routine custodian shuffle, social media panics. It triggers trading algorithms. It causes flash crashes. In a way, opacity protects the market from noise.
Opacity protects the market. That sounds an awful lot like the old traditional finance line of just trust us, we have it under control.
It is standard practice for securing institutional assets. And look, even if they don't publish the exact addresses, the breadcrumbs are absolutely there. As you admitted yourself, Arkham did locate BlackRock's 756,000 units. It matched their public reporting almost perfectly. Furthermore, the CEO of Coinbase recently did an AMA where he addressed this head-on. He explicitly confirmed that the assets sold to institutions are real, they are one-to-one backed, and they are not rehypothecated.
A CEO saying, "Trust me," is not cryptographic proof. The entire ethos here is don't trust, verify. If I can't verify it on the public ledger, it is a liability.
But at what point does that demand for verification just become paranoia? If BlackRock, the SEC, Coinbase, and the top accounting firms are all conspiring together to fake the balance, we have a much bigger problem on our hands than just cryptocurrency.
Millions of coins into a handful of honeypots, places like Coinbase Custody or Fidelity Digital Assets. We are creating massive single points of failure. Arthur Hayes said something in an interview back in June 2024 that really haunts me. He pointed out that if a major crypto custodian gets hacked and loses $50 billion to $100 billion, it wouldn't just dip the price, it could end the entire market cycle. It could set the industry back 10 years.
Centralization of custody is a valid concern. I definitely won't argue that holding 2 million coins in one entity is risk-free.
And it's not just the risk of hacks, it's market manipulation. Let's talk about price suppression. We have seen this exact playbook in the gold market for decades. The paper gold market, the futures and derivatives, is hundreds of times larger than the physical gold market. This allows Wall Street to sell limitless amounts of paper gold to essentially suppress the price of the real thing.
And you think they are doing that to Bitcoin?
Look at the massive corporate buys. Critics have pointed this out for years. A major corporate treasury announces they are buying $500 million worth of the asset. In a strictly supply-constrained market, a purchase of that size should shoot the price to the moon immediately. But historically, the price barely moves at the exact moment of purchase.
That is not manipulation. That is just smart execution.
Explain that.
If you are an institution buying $500 million of an asset, you don't go to a public retail exchange and just click Market Buy. If you did that, you would blow out the entire order book and you'd end up paying a 20% premium. You use OTC desks, over the counter. You match with the seller off the public books, you agree on a locked price, and you settle it. The demand is eventually reflected on the market, but it happens smoothly. It's not a conspiracy to suppress the price. It's just how you buy size without getting wrecked by slippage.
Or it suggests that the buying pressure is being absorbed by derivatives in paper claims, which decouples the price from the actual scarcity of the asset. And now we have governments entering the game. The U.S. government holds over 320,000 units. China has 190,000. This is paper Bitcoin influence at the state level. They can use that immense supply to cap volatility or shape global narratives around the asset.
I actually view that lockup quite differently. When the U.S. government or a massive corporate treasury holds the asset, they are effectively taking it out of circulation. They aren't sitting there day trading it. That massive reduction in circulating supply is incredibly bullish for the price floor over the long term. But more importantly, these paper instruments allow for what I call safe entry.
Safe?
Yes, safe for the 99% of the world that is not technical. Do you really expect a pension fund or someone's grandmother to manage private keys on a hardware wallet, to worry about firmware updates and seed phrase backups? Self-custody is a cliff that most people will simply not jump off. Paper Bitcoin, and ETF specifically, bridges that gap.
It's a bridge to a rental agreement.
It's a bridge to ownership. And the regulatory landscape is actively evolving to address your specific fear of fake Bitcoin. There was a massive regulatory shift last July that I think completely undermines the argument that it's just paper. The SEC approved a rule change allowing ETF shares to be exchanged one-to-one for the physical asset.
I will admit that rule change was a surprise.
It's huge. It means the paper is legally redeemable for the rock. It creates an active arbitrage mechanism. If the price of the ETF falls below the price of the actual asset, large traders can buy the ETF, redeem the physical asset, and sell it for a profit. This forces the paper price to stay perfectly true to the real price. It completely prevents the paper gold decoupling you are so afraid of.
That redeemability is a great feature for the authorized participants, the market makers and the institutional giants who can actually meet the minimum redemption thresholds, which are usually in the millions of dollars. But for the average retail user holding a share in their brokerage account, they can't just click a button and get the asset sent to their personal wallet. For the retail user, they are still just holding a receipt.
Not yet. But the plumbing is actively being built for that level of integration.
Well, while we are on the topic of plumbing, we have to address the other elephant in the room, the decentralized finance version of paper. Wrapped Bitcoin?
I was wondering when we'd get to this. WBTC, CBTC. This is actually the counter-argument to your centralization point.
Is it? Let's define it first so we're on the same page. Wrapped Bitcoin is when you take the real asset, lock it in a digital vault, and mint a token on a completely different blockchain, usually Ethereum, that represents that original asset.
Exactly. It allows the asset to actually do something. Instead of just sitting idle in a cold wallet like a pet rock, it can be used productively in decentralized finance. You can lend it out, you can use it as collateral, you can earn yield. It makes it a productive asset. And unlike the Wall Street ETFs, wrapped protocols usually offer real-time proof of reserves directly on-chain. You can actually see the backing sitting in the vault at any given second.
You can see the vault, sure, but you can't see the key. The risk here is arguably much higher than with an ETF. You're introducing a massive technical bridge risk. We have seen billions of dollars lost in bridge hacks across the industry. If the custodian holding the real asset gets hacked or simply loses the keys, that token in your Ethereum wallet becomes instantly worthless. It goes to absolute zero.
That is a technical risk, I agree, but it is a verifiable risk that users can assess for themselves.
It is also a leverage bomb. Because wrapped Bitcoin is used in DeFi, people constantly borrow against it. They loop their exposure. They put up $100 of wrapped tokens to borrow $50 of stablecoins just to buy more wrapped tokens. When the market dips, and we both know it always dips, these over-leveraged positions get liquidated automatically by smart contracts. This leverage cascade severely exacerbates market crashes. It turns what should be a healthy 10% correction into a 30% crash. Paper Bitcoin and DeFi simply amplifies volatility.
It amplifies volatility, yes, but it also amplifies utility. We really have to decide what we want this asset to be. Do we want it to be digital gold that just sits in a vault forever, totally inert? Or do we want it to be the base layer of a new global economy? You cannot have a global economy without credit, without velocity, and without complex financial instruments. Paper Bitcoin in all its forms, whether it's wrapped tokens, ETFs, or futures, is exactly what turns the rock into actual money.
And I would argue that it is money specifically because it doesn't require a bank, a wrapper, or an ETF manager to validate it. Every single layer of paper you add is a layer of friction and a layer of trust that dilutes the core value proposition of a trustless system.
So where does that leave us? Because we certainly cannot put the genie back in the bottle. The 2024 high of $126,000 didn't happen because of retail users buying $50 on the weekends. It happened precisely because of institutional flows moving through these exact paper instruments.
I agree that paper Bitcoin pumps the price. I don't dispute the capital inflows. But my closing thought is this. While it drives capital, it inherently centralizes power. Well, the actual underlying asset sits in centralized custody, completely inaccessible to the masses. If the price goes to $1 million, but you have to ask permission from a corporation or a government to spend it, have we actually won? True safety lies only in self-custody. If you can't touch it, you don't own it.
I respect the philosophy, but I remain optimistic about the reality of the market. Paper Bitcoin is the transition phase. It is the necessary bridge from a niche tech experiment to a mature global reserve asset. The risks of the past, the Mt. Gox era, are steadily being mitigated by better regulation, audited custody, and now the legal right to redeem shares for the underlying asset. We are moving toward a world where the paper and the real are interchangeable, not oppositional. The ability to redeem ETF shares strongly suggest a convergence of these two worlds.
Convergence is nice in theory, but financial history teaches us that paper claims always eventually outnumber the real assets. Until you hold the private key, you are just an unsecured creditor in someone else's system.
And that is exactly why the push for verification, whether it's proof of reserves in DeFi or strict ETF audits, remains the critical friction point for the future of the industry. But for now, the liquidity is undeniably here.
The liquidity is here, just make sure your exit strategy is too.
That's all the time we have for today. Thank you for listening to The Debate.